Today, the vast majority of investors have been assured that there is no chance of a market crash, extremely low probability of a market correction, and an increasing likelihood that more stimulus is always around the corner. If these conditions remain, what happens to the market? Can this be a permanently high plateau? You came here for the truth, so let me unveil that for you. I thought it would be an interesting video if I played devil's advocate and I actually looked at the possibility that what we're seeing today will never end. I'm going to show you everything that's happening today, all of the conditions that have basically put us where we are, and I'll give you the updates as you need them. Then we're going to look at what could potentially change that. And this right here is something so key to watch. We are talking about critical indicators that a person should be aware of, knowing that if everything stays the way it is, perhaps the markets can rise permanently. That's what you're being told. That's what they're saying. So let's look at that possibility today. Of course, we have the markets up and away. This happens to be the S&P 500, but of course you can see what has happened over the last year. They've basically been going up in a straight line. Take the 5-year, take the 10-year, and of course they continue to rise. Why they're rising? Well, we've got more on that. But the point remains is that you could buy in at any point in the bull market, and of course, you would make a lot of money. That's what's been happening. That's the way the conditions currently set in place have really led up to at this point. The primary factor here is, of course, interest rates. This happens to be the Fed funds rate. You can look around to different central banks and see where their interest rates are, and I assure you they are at or near record lows. This happens to be since the financial crisis, and you could see they brought interest rates down to rock bottom, kept them there for many, many years, started to increase them slowly, and then had to quickly bring them back down again. And now we are in the understanding that at least until 2024 hits, you're going to have 0% interest rates. That's the reality of what we have today. The balance sheet of the Federal Reserve and, of course, all other central banks has risen dramatically. In the case of the Federal Reserve, it is over $7.8 trillion. We have seen the expansion coming. It really in these two forms, the beginning of the financial crisis, and then of course around 2020, we've seen the balance sheets increasing at a time in which interest rates are really low, and this has a major stimulative effect. On top of that, we have the stimulus coming from the government. They are providing the fiscal stimulus. We've got the infrastructure packages. We've got the checks going directly out to individuals. There is a multifaceted approach that's being taken today. And of course, some of that money makes its way into the economy, especially when people are given the money directly, then they go out and spend it. And that's the whole point in order to sort of supercharge these markets. And they've made it clear that they don't want this to stop. They don't want to stop the low interest rates and the money printing and of course the stimulus. They want it to continue. And then you look at the conditions deeper in the markets and you see what's been happening with bonds. This happens to be talking about the negative yielding debt, which has fell below $15 trillion worth. Still excessive, but the direction is clearly here. You can see that trend. And I think it's important to address where the money is currently going. You could see that there is less of a demand for the negative yielding debt. You have investors that want a return on their money, and for obvious reason. Looking around, you see that governments want more negative rates to come. They don't want to change from this policy. This is something that central banks have implemented as an experiment. And, you do see the consensus that it's not necessarily a zero bound being, this barrier that they can't cross. Many of them have really, especially if you look at this article here, talked about how fantastic they are. As a result of the negative rates, you have investors looking to where they can put their money. And this happens to be one of them, equity allocation. You can see the holdings here as a percentage of the assets under management. This equity allocation hits another new high at 64.3%. More investors parking their money into stocks. Why? Because they can get a return that, quite frankly, they cannot get in bonds, particularly when you've got $15 trillion worth at a negative yield. Speculative assets are on the rise, whether that's cryptocurrencies, whether that's NFTs, trading cards, sneakers, anything. You see that more money is flowing into these new technologies and, of course, other things that have been around a long time, like the trading cards, where more money is pushing these up to higher and higher prices. Along with the higher prices, we have seen, of course, real estate that people have to buy to live somewhere, their food prices, lumber prices, everything is increasing. So what do people do? Well, they aren't going to get paid any more money. Their salary's not increasing. So they have to make money in a different way. And so that's why more of them are being pushed into not keeping the money in the bank, but instead trying to invest their money. Some would argue today that what we are seeing with the stimulus, with the central banks, are not actively creating inflation in the sense of prices rising. They suggest that the prices that are rising today are temporary. We'll see what happens in the long term, but this is the velocity of money. And you can print a lot of money, but unless the velocity is there, then you don't have rising prices. That's the suggestion. And so we will see what happens. In conjunction with this, we have technological advancements that have happened, which are generally deflationary. So that, of course, has an impact as well. And you could see what has happened since the late 90s. The velocity of money has clearly been declining. With everything I just showed you, if all of that remains in place, then of course, current trends can continue. That's obvious. Everything is there. You've got the markets already on a tear. You've got interest rates low. You got the money printing. You've got the stimulus packages. You've got less opportunity in bonds, which many years ago was a much better investment as an investor. So where does the money go into? Well, they're looking for risk assets. Risk on is the mentality today. Corrections in the stock market can happen. Of course, the market can fall by the technical term of correction, meaning 10% or more. You could have 5% here or there, some consolidation for a period, and then it rises higher. You have major events like what happened March 2020, and then the market continued to rise after that. But for a major collapse, you need a catalyst. You need an actual trigger event. And until that point happens, markets can absolutely go higher. What could be a catalyst? Well, there are any number of events, and there needs to be the sensation that there's too much uncertainty here to keep the money in, And the valuations have had to be extremely high at that point. So investors start to take some off the table, and then more off the table, and then more, and then more, and then a cascading event occurs. And so people are always asking the question, the obvious question, when? When is that actually going to happen? Well, if you looked at all of the technical indicators today, a growing number of them have suggested we are in the most speculative boom ever in history. There are so many of different indicators, but like I said, without that catalyst, there is no way that the market can just fall on its own. It doesn't happen like that. There needs to be an event. So that question when is of course impossible to determine. But as I've said, you look at all the indicators, you see them all piling up, and of course, this is something that is very unusual historically. The times we have today are truly an anomaly, but we need to address it for what it is. It is very important to see the overwhelming stimulus, the negative interest rates in bonds, the fact that interest rates are so low in general, and the euphoria behind it all. So what you do with your money, that's up to you. But this is the truth. This is the information that we've been dealing with so far, and I found it interesting to have a different perspective here. This is not necessarily devil's advocate because it's something that I've always covered. I've always shown you this. But that trigger event, of course, will be something that nobody expects. So as I always suggest right here in the Money GPS Insights, hedge your bets because you never know what's going to happen. That's all for this video. If you found it informative, hit that thumbs up button. Simply by clicking that button on your screen, you are supporting this channel. And if you aren't already aware, you need to be clicking on the subscribe button. You've got to hit the little bell and make sure that you are notified. Look, a very small percentage of the people that are viewing my videos are actually subscribed. And so many times for so many people, even regular viewers, they find themselves not even subscribed anymore. So make sure you click that little bell and indicate that you always want to be notified. All right. And if you want to learn about e-commerce for free, you can do so at the AmazonGPS.com. And the financial system being so complex and convoluted, you can learn it all in these two books. Have that great foundation of knowledge simply by reading these two easy to read books. The link is in the description. Have you seen this? Well, if you haven't, you definitely want to check it out. Click it and I'll see you there.